Good evening, students. My name is Karan Sukramani. I am the faculty for the session today. Today, we are going to discuss the chapter 12 of the direct tax and international tax law subject. The topic for discussion today would be taxation of digital transactions. Now, this chapter would largely cover two topics. One would be equalization levy, and another would be taxation of virtual digital assets. Just before we begin, let us have a brief overview of the chapter. What is it that we are going to discuss today in relation to the equalization levy as well as the virtual taxation of virtual digital assets? We'll see a little bit of background as to how, when, and why the equalization levy was introduced in India. We'll also discuss the OECD and the action plan 1 of OECD. So far, you may be new to this topic, but then we'll give a brief about BEPS action plan 1. And that is basically the genesis for introduction of the equalization levy in India. We'll also discuss the taxation of virtual digital assets, that is cryptocurrencies and digital assets. First half of the session, we will focus exclusively on the equalization levy. And in the second part of the session, we'll have a Q&A session for equalization levy. And then we'll spend almost 45 minutes to 1 hour on the virtual digital assets. Before we begin the topic, let us try to understand why are we studying the equalization levy. So students, what was happening? So as we all know, earlier, prior to the age of internet, the businesses were largely local. When I say local, I'm saying that they were largely physical. All the sales, purchases, the transaction was happening within the boundaries of a particular country. So in case of a cross-border transaction, it was very easy for the government to identify the kind of activities that are happening in a particular geography, the level of activity, the intensity of activity, and the nature of transaction. It was all visible. Now, because of internet, today you see all transactions are now being undertaken almost virtually. What kind of business models that we have, or what kind of businesses that we have in the technological world? Let us try to see the conduct of business in digital economy. So these are various kinds of transaction in an e-commerce business model. One is B2C, business to consumer. Then we have B2B, business to business. We have G2C, G2B, and then C2C, consumer to consumer. Now, all these business models were there even prior to the e-commerce or the internet age. They were there, but then it was very easy to identify the activity and then to tax that transaction or to regulate those transactions because these activities were happening in a physical world and everything was visible to the government. Now, in a technological world, it becomes very difficult to tax a particular transaction which is happening in a digital world. Let us try to understand this through the concept of business connection or permanent establishment. Let me just go back to the basics for a while and then I touch upon this chapter. Section 5 of the Income Tax Act. This is the basic and fundamental section. This defines the scope of total income. So there are various limbs to Section 5. The section reads, subject to the provisions of this Act, the total income of any previous year of a person who is resident includes all income from whatever source derived, which is received or is deemed to be received in India in such year by or on behalf of such person. So the first important point is income which is received in India. Then it says income accrues or arises or is deemed to accrue or arise to him in India during such previous year. The third one, income accrues or arises to him outside India. Now, this is so far as the person who is resident in India. So when a person is resident in India, his worldwide income, whether it is received in India or outside India, whether it accrues to him in India or outside India, it is taxable in India. So if I'm a businessman, I'm running a small grocery shop in my locality, then all my income is taxable in India. Same example, I'm a businessman. I have got, say, for example, a business outside India as well. There also I'm running a grocery shop. That income will also be taxable in India because I'm resident in India. And because I'm physically in India as an individual, my stay is in India for more than 182 days. Or if I'm a company, then I'm incorporated in India or my place of effective management is in India. It is easier for the government to trace the transaction, to enforce the recovery mechanism. If the government has brought in a tax law, it is not possible to enforce it, then the law becomes redundant. So we have a taxation law, Income Tax Act. Then we also have a procedure to collect and recover the tax. So far as a person who is resident in India, it is very easier to implement. When it comes to non-resident, let us see what is the scope of total income in case of a non-resident. Subject to the provisions of this act, total income of any previous year of a person who is a non-resident includes all income from whatever source derived, which is received or is deemed to be received in India in such year, or accrues or arises or deemed to accrue or arise to him in India during such previous year. So what it says that in case of a non-resident, if I am a non-resident, who is a non-resident, it includes income which is received or deemed to be received in India. It is easy to track if the income is received in India, meaning thereby you have got a bank account in India and the money is getting credited. So at least it is easy for the government to track that transaction. Income accrues or arise or deemed to accrue or arise to him in India. Now, what do we mean by the term income which accrues or arises? Or what do we mean by the term income which is deemed to accrue or arise in India? Let's just try to understand Section 9. I'm just briefly touching upon these provisions as of now because you will have a separate session on the taxation of non-resident. But to understand the rationale or why the equalization levy was introduced in India, it is important that we go back to basics and understand what are the limitations in Section 5 as well as in Section 9 of the Income Tax Act. Section 9. What is the scope of taxation and why the equalization levy was introduced? So if you look at Section 9, that says that following income shall be deemed to accrue or arise in India. This is a deeming provision. Whether it arises in India or doesn't arise, we are not concerned. It will be deemed that income has accrued or arose in India. 1. All income accruing or arising, whether directly or indirectly, through or from any business connection in India. So the first condition is you should have a business connection in India. Take an example of a Netflix. We'll continue with this example throughout our session today. The Netflix. Everyone knows what Netflix does. It is a streaming app. It's a streaming website where a lot of content, video content, movies, dramas, web series, they are uploaded on a website. Those videos and websites are available to users worldwide. Now, Netflix is a US company. The website which Netflix has developed is also located outside India because the server in relation to that website, the server which hosts all kinds of programs, they're all located outside India. So Netflix is a US company. So for Indian income tax purpose, it is a non-resident. Netflix hosts a lot of shows. It collects money from various users across different countries. Now the question comes, how do Netflix complies with the Indian tax law? Now from India, it is earning huge revenue. India is a country with 140 crore plus people. there would be billions of money that goes outside India by way of payment through credit cards, payment gateways, and various other modes of transfer, including crypto exchange. We make payment to the Netflix. Now, all those profits are accumulated outside India. Now, the question is whether Netflix is liable to pay tax in India. That's the first and fundamental question. So if I just step back and go to section 5 once again, you will see that Netflix is a person non-resident in India, subsection 2. Whether income is received in India, the answer is no. When I'm making payment to Netflix, I'm making payment to the bank account of Netflix, which is in US. So the payment is not received by Netflix in India. It is received from India, but it is not received in India. Second, whether the income is accruing or deemed to accrue or arise in India. For that, let us see section 9. Following income shall be deemed to accrue or arise in India. Income accruing or arising, whether directly or indirectly, through or from any business connection. Second, through or from any property in India. Third, from any asset or source of income in India. And fourth, through or from transfer of a capital asset situated in India. Now, whatever revenue that Netflix is earning, is it from transfer of a capital asset in India? Answer is no. So we will remove it. So this is not applicable. Is it from a property in India? Netflix does not have a server in India. Netflix is not required to have any kind of office in India because the business model of Netflix is such that it's completely on website. It doesn't have any physical infrastructure, or it doesn't require it all. So it doesn't have a property in India. So this condition is not fulfilled. From any asset or source of income in India. Now this is not defined. It's a very subjective term. Now let's say Netflix has a source of income in India because it is earning revenue from India. So let's say this condition is partially fulfilled. Whether Netflix has a business connection in India. Now, how it has a business connection, we'll discuss little later. But let us say that yes, Netflix has got a business connection in India. So Netflix has a business connection in the form of large presence of users, and the meaning of business connection has now been expanded to include the significant economic presence, which was not earlier. So if I talk about the position prior to Finance Act 2018, then significant economic presence provisions were not in the statute. So at that point of time, Netflix did not have or is not said to have any kind of business connection in India. So what was happening? Under the domestic tax law, there was an ambiguity that the foreign corporations like YouTube, Google, Facebook, Instagram, Netflix, all these kinds of companies, they are earning huge revenue from India. But when you look at their operations, they do not have employee in India. They do not have website in India. They do not have any kind of physical presence in India. It's all happening virtually. So the government thought, how do we tax these companies who are earning huge amount of revenue? So then it was thought that let us look at our domestic law provision. Now, if you see, as we discussed, the definition of business connection, now it has been expanded to include significant economic presence. Prior to Finance Act 18, SEP, significant economic presence concept was not at all there. So the taxpayers, that is Netflix, Google, and foreign companies, they were all contending that we do not have any kind of presence in India. And in the absence of any presence in India, we are not liable to pay any kind of income tax in India. That was contention number 1. Now, say for example, if at all the definition of business connection is held to be so wide to include even the virtual presence in India, they are definitely liable to tax in India under section 9. But then wait, we have something called as double taxation avoidance agreement, called as DTAA. What does it say? So before we go to DTAA, let us see section 90. So there is a term called double tax avoidance agreement. What it does, there are organizations or taxpayers who undertake business activities in a cross-border scenario. Each country will levy tax based on the activity that happens in that jurisdiction or based on the source of income in that jurisdiction. I am conducting this lecture in India. Let's say I have got students in UAE, I have got students in, let's say in US. Then what will happen? Those students will make payment, whatever it is, to the Institute of Chartered Accountants of India. Now, ICAI, for example, take it as an example as an educational institution for time being, a profitable educational institution doing activities across different borders. It is liable to pay tax in India because it is resident of India. Now, for users outside India, the domestic laws of foreign countries will also say that it is liable to tax in outside jurisdiction. So there is a double taxation which is happening. On the same amount of profit, India is levying tax. On the same amount of profit, foreign countries also levying the tax. Then what will happen? There is a case of double taxation. So the countries came together, they signed the double tax avoidance agreement. The double tax avoidance agreement essentially helps to sort of relieve a taxpayer from double taxation, and it distributes the taxation rights between two countries. We have more than 90 tax treaties with different jurisdictions. Like India has signed almost all with major developed and developing countries. India has signed the tax treaty, and the tax treaty relieves the taxpayer of either of these countries from the double taxation. Now that agreement is entered into under section 90 of the Income Tax Act, as you can see. Central government may enter into agreement with the government of any country outside India or specified territory outside India. For what purpose? For granting of relief in respect of one, income on which have been paid both income tax under this act, that is Income Tax Act, and income tax in that country or specified territory. Second, income tax chargeable under this act and under the corresponding law in force in that country or specified territory to promote mutual economic relationship. That is the second objective. Third, for avoidance of double taxation of income under this act and corresponding law in force in that country without creating opportunities for non-taxation, to ensure that assessee doesn't pay tax in either of these jurisdictions. So that is also one of the objective of tax treaty that is recently amended. For exchange of information, somebody is having immovable property, let's say in UAE, in different countries, let's say in US, Germany, Switzerland, but he's a resident of India, he's earning a lot of income out from that immovable property, or it can be anything. Then it requires the government to exchange the information. So this agreement allows the government to exchange the information so that tax can be recovered. So this is just an example purpose. Section 90 allows the country to enter into a tax treaty. Now let us come back to the same example for a moment. What was the example? Netflix, which is a US-based company having website outside India. Users are in India. Users are paying revenue to it. Netflix claims that it is not liable to tax in India. Number one, business connection definition is not wide enough to tax the transaction of Netflix. If at all, it is covered under Section 9 into business connection definition. It is still not liable to pay tax in India because it does not have, now this is very important, it does not have a permanent establishment in India. Permanent establishment, also called as PE. What does it mean? So under the domestic law, we have a concept of business connection. Under the tax treaty, the same terminology is popularly called as a permanent establishment. So what happens that in case of a cross-border transaction, a non-resident is governed by the provisions of Income Tax Act, which is domestic law, or tax treaty, whichever is more beneficial to him. I repeat, in case of a non-resident, he is governed by domestic law or DTAA, whichever is beneficial to him. So if the transaction is not covered under domestic law, then matter ends there. If the transaction is, let's say, covered under domestic law, but then he has got a protection under treaty, that means it is not covered under the treaty, then he will again get a benefit. The transaction will not be covered, it will not be taxable in India. If the assessee is covered under the domestic law and he is also covered under the DTAA, then transaction will be taxable in India. So that is in nutshell. Now let us try to read what does the mean permanent establishment mean. So if you can see, I have reproduced just a brief extract of the definition of permanent establishment contained in a tax treaty. For the purpose of this convention, that means agreement, the term permanent establishment means a fixed place of business through which the business of an enterprise is wholly or partly carried on. Now, what is important to note here is, in case of a non-resident, again coming to the Netflix example, whether the question is whether it has got a permanent establishment in India or not. So permanent establishment means fixed place of business through which business of an enterprise is wholly or partly carried on. Now, what is important to here observe is fixed place of business. Whether Netflix has got a fixed place of business in India, answer is no. Let us see other condition. Whether Netflix has got place of management in India, answer is no. Its place of management is in US. Whether it has a branch in India, no. Office in India, no. Factory, not applicable. Workshop, not applicable. Mine, oil, gas well, quarry, or any other place of extraction, not applicable again. So you can see that even in a treaty scenario, a non-resident Netflix example, it can be applicable to Google, it can be applicable to LinkedIn, all these apps that we use, whether it is US based app or it can be anywhere in the world other than India. They do a lot of business with Indian users and likewise with other countries. But then this permanent establishment concept is not applicable to them. So to say that they do not satisfy the definition of permanent establishment and therefore their income is not liable to tax in India. So what do we do in that case? The government said, okay, if we enact an income tax law, they easily get away from the taxation point of view because you are governed by the treaty. If we need to amend the treaty, it is not possible for us to do it unilaterally or individually because treaty is an agreement between two countries. That is, double tax avoidance agreement is an agreement between two countries. So we cannot amend the treaty easily or in a faster manner. So what is the solution? Then everybody was discussing this issue. Like India, we had many other countries facing the same problem. So OECD, which is called as Organization for Economic Cooperation and Development, which is a group of mostly developed countries, they came together, they formed some action plans, some research reports. They came out with 15 action plans. So now we'll go back to taxation of digital transaction. So these are all business models. I'm not getting into each of these because you are quite familiar with them, like business to consumer. These are examples like Amazon, Flipkart. They are all business to consumer transaction. Then we have business to business transaction, B2B, like India Mart, Trade India, Alibaba. We have government to customers. We have government to business, business to government, like for example, e-marketplace, or take the example of Startup India. So it is government to user or government to business where they provide a lot of subsidies, registration options, e-procurement options. Consumer to consumer, take an example of OLX. It's a platform where one person is selling his used products or goods to another buyer. So these are all virtual business models or digital business model. Then we have online platform e-commerce business model, Netflix and all. We have marketplace based model or inventory-based business model. So what is this market-based, place-based business model? So it's an e-commerce means providing an information technology platform by an e-commerce entity on a digital or electronic network to act as a facilitator between buyer and seller. So it is again coming to the same. We understood B2C. So this is also marketplace business model where take an example of Amazon. What it says, it doesn't own the inventory. If you want to buy a laptop, the laptop would be sold by companies like HP, Lenovo, and Dell on the platform, and there would be the buyers on the other end. What Amazon is doing, it is just working as an aggregator model. It is giving a marketplace. It is operating a website. Buyer and seller can come together. They can transact or execute a transaction, and Amazon will be entitled to certain percentage of commission. Then we have inventory-based business model. So it's an activity where inventory of goods and services is owned by e-commerce entity and it is sold to the consumers directly. So can you suggest any example of inventory-based business model? Anybody want to try? What are the inventory-based business models? Okay. So take the example of Lenskart. What it does, it has its own website. It sells the specs, lenses, but then it also has his own sort of production facility and it sells the inventory through its offline stores, of course, but also it started with the online first. So it says, take the example of Chroma. Chroma has its own website and yes, ICAI CDS portal. So that is also inventory based platform. Perfect example. So these are business models and these are quite evolving. Take the example of cryptocurrency, where one person can sell the crypto through exchange or even without exchange. Subscription e-commerce business model. So for example, Kindle, Amazon Kindle, you can buy the books online on the website and you can subscribe to those books. Digital identity and its potential for e-commerce, subscription, access to tangible or bundled goods. So I'm not getting into each of these business model in detail at this moment because you are quite familiar with this and you often use those. Our purpose for today's discussion would be mostly towards the taxation of these business model. Online, offline e-commerce business model. So again, the same example of Lenskart. It sells the specs online also through the website and it also sells through its offline portal or physical shops, brick and mortar stores. Digital wallets like payment gateways. So there are peculiar issues that we face in all these business models. Earlier, it was, as I mentioned, it was only one. You go to a store, go to a mart, you buy something, and you come back. That's the end of the story. But now, if you want to buy anything, the first thoughts today that comes to our mind is we just immediately pick up our phone or laptop, tablet, and then we immediately search the product online and see on which website it is available, what is the cost, by what time it can be delivered, and we do that transaction. And gradually, the speed at which the growth of digital transaction is happening is phenomenal. Earlier it was economy, today it is digital economy. Separately by itself is an economy. So yes, so someone has asked, please throw some light on the OECD. So okay, we all understood that all countries are facing the same problem. The solution also needs to be agreed unanimously and it should be consistent across all the jurisdictions. It cannot happen that one country has got a different tax law for taxing the e-commerce transaction and another country has got a different tax law and variety, because that creates a lot of problems for the businessman. So what happened? All of countries came together. Now there is a term often which is used is OECD. OECD is nothing but an international organization. It is not a government. It is an international organization where different governments come together, they discuss what are the issues, and they try to come out with some model suggestions for digital transaction or digital economy, taxation of digital economy related issues also. So they all came together and then they formed sort of a task force on digital economy, and they came out with 15 action plans. One of the action plan was action plan 1, that is okay. So what was the in 2015 the reports came, and it was popularly called as BEPS project, base erosion and profit shifting. And one of the action plan which they recommended was BEPS action plan 1, and that action plan identified various issues. What was the issue relating to taxation of digital transaction? The difficulty in characterizing the nature of payment and establishing a nexus or link. So as you can see, difficulty in characterizing the nature of payment and establishing a nexus or link between taxable transaction, activity, and a taxing jurisdiction. So why there is a difficulty in characterizing the nature of payment? There's a concept of fees for technical services. I'm just taking a simple example. If I'm making a payment to a foreign company, if the transaction is in the nature of fees for technical services, Section 9 says, if it is a fees for technical service, the transaction is taxable in India. Now, often when I'm making a payment for availing some services, the question comes, if the services are rendered through an organization or a foreign multinational company in a digital mode, and often it becomes difficult for us to determine whether the service is a technical service or not. Then let us say it is a technical services. Then the issue comes whether that service has got any kind of nexus in India. As a country, we cannot tax all kinds of transactions undertaken by non-resident. It is only when a non-resident has got some kind of nexus means connection, some kind of connection with India, only then you can tax those transactions. In a digital transaction, it becomes very difficult to establish a nexus or a link between the transaction, activity, and the taxing jurisdiction. Then there's a difficulty in locating the transaction, activity, or even identifying the taxpayer for income tax purpose. Now again, take the example of Netflix. You watch a lot of videos on Netflix. Now there would be some web series, some programs or some content which is developed not in USA, but let's say in Switzerland, somewhere in Germany, or it may be in different countries that program might have been recorded. So the question comes where the value has been created, where the essential activity has been undertaken, that country has a predominant nexus or predominant sort of right to tax those transactions. But how do we determine that in a digital world? It's next to impossible. So these were the main issues which were identified. So then government thought, okay, we have action plan 1, taxation of digital economy. So they suggested some recommendations or suggestions. They said, okay, these are the ways in which the countries can introduce some laws. First, a new nexus rule in the form of significant economic presence. Now, what is significant economic presence? It says that you introduce some law into your domestic law that may be called as a significant economic presence test, whereby if the country is not having a physical presence in your jurisdiction, but it has got a lot of users, it has got an X amount of revenue, there are different thresholds that may be prescribed or introduced by the government. You tax those transactions based on the SEP. If that threshold is triggered, then you have got a taxing right. Option 2, you withhold tax. Withholding tax is nothing but TDS. You introduce some kind of TDS on the digital transaction. When an Indian resident is making payment to a foreign country, if the transaction classifies or if transaction satisfies some of the conditions, then you collect a TDS out of it and let it be a final tax liability. Now, in both these proposals, the problem was that both these provisions are to be introduced into the domestic law. But as you all know, there is a domestic law at one place, then there is a tax treaty on the other side that we call as DTAA. Now, DTAA overrides. Overrides means whatever is beneficial to the assessee, that will prevail. I will still be governed by treaty because treaty is not yet amended. I am not covered by the permanent establishment rule. So treaty will always prevail. Domestic law will not prevail. So the government said, okay, even if we introduce these measures, the Indian government thought it will have no relevance at this moment because wherever we have a treaty, taxpayer will still be covered by treaty and he will not be making any payment of tax. So then OECD also suggested the equalization levy. Now this equalization levy was suggested by OECD, but then with the caveat that you need to ensure that you also sort of honor your treaty obligation. But then what happened? In 2015 or 14 or 15, these reports were introduced somewhere towards the end of 2015 and early 2000, end of 2014 and early 15. These reports were launched by the OECD. And then immediately in the next year, in 2016, by Finance Act 2016, the equalization levy provisions were introduced. Now, let us jump to the equalization levy provisions and see what it says. So as you see, consequent to BEPS, BEPS is base erosion and profit shifting. So I'll just note down for your reference. This was the project name, base erosion profit shifting BEPS or BEPS, which was sort of named by the OECD. And the action 1 was one of the 15 action plans. So this equalization levy was an option first chose by India, and what it says. Now let us try to understand the provision. It provides for an equalization levy. I am reading from this line. This was introduced by Finance Act 2016. Now, students, please note that equalization levy is not part of Income Tax Act. So please do not carry this confusion that it is a part of Income Tax Act and levy is levied or charged under the Income Tax Act. No. So we had budget during 2016, and in that budget, the proposal was to introduce equalization levy, and that when budget finance bill was finally enacted, we had Finance Act 2016, and this equalization levy is levied under the Finance Act 2016, not under the Income Tax Act. So what it says, it provides for an equalization levy at the rate of 6% of the amount of consideration for specified service received or receivable by a non-resident not having PE in India from a resident in India who carries out business or profession, or from a non-resident having PE in India. Now let us see what are the conditions. When is equalization levy applicable? So there has to be, okay, so before that, let me just come into this conditional section. So for any levy, first there has to be a charge. If there is no charge, the levy will not be. So in all revenue law, whether it is GST, whether it is income tax, or whether it is equalization levy, all kinds of law will always have a charging section. First, the charge is created. So what it says, as you can see on the screen, equalization levy at 6% is leviable on what? On the amount of consideration for specified service received or receivable by a person being a non-resident. So the first condition is you have to be non-resident. From first, you have to be non-resident. Then from a person resident in India and carrying on business or profession, or a non-resident having PE in India. So I'm reading it again. Equalization levy at 6% is leviable on the amount of consideration for specified service. So specified service. You have to be non-resident. The consideration should be only in relation to the specified services. From whom? Who should be the payer? Person resident in India and carrying on business or profession. So resident plus someone who is carrying on business or profession. So the payer of the consideration should be resident plus he is carrying on business or profession. 2, a non-resident having a PE in India. So 1 is this, 2 is NR plus P. So first you identify who is receiving the consideration. It is the non-resident. Who is the payer? Payer is resident and he is carrying out business or profession. Payer is non-resident and he has got a PE in India. Let's see when it is not applicable. Let's understand what is the meaning of specified service first. Specified service means online advertisement, any provision for digital advertising space, or any other facility or service for the purpose of online advertisement. Any other service has been notified by the government. So nothing has been notified so far. So as of now, it would be only 2: online advertisement and any provision for digital advertising space. So these 2 services are covered specifically. So friends, first condition, you have to be a non-resident. The consideration is received or receivable from a payer in India who is resident and carrying on business or profession. So the person making the payment is resident and he is carrying out the business or profession. If he is not carrying out business or profession, like me, I'm a single user of, let's say, LinkedIn. I advertise my products on LinkedIn. I'm a businessman. Then yes, equalization levy would be attracted in this case if I'm making payment for advertisement to LinkedIn or Facebook or any other company. If I'm a non-resident, so transaction is happening between 2 non-residents, then equalization levy will be attracted only when the non-resident who is making payment to another non-resident has got a permanent establishment in India. That is, the logic is very clear. Unless you have got some kind of presence in India, the transaction will not be covered. One NR making payment to another NR, equalization levy question doesn't arise in India if none of them have got a permanent establishment in India. When EQ levy is not chargeable to tax. So this is very simple to understand. 1, when the non-resident providing the specified service, he has got a PE in India. And the specified service is effectively connected with such PE. PE means permanent establishment. 2, so we are discussing when equalization levy is not applicable. Aggregate amount of consideration for specified service received or receivable in the previous year by the non-resident from a person resident in India and carrying on business or profession, or from a non-resident having PE in India does not exceed 1 lakh. So second is very simple. If the aggregate amount of payment doesn't exceed INR 1 lakh rupee, then equalization levy doesn't apply. So you have to see the transaction value individually. No, you have to see it in aggregate during the financial year. So the aggregate amount of consideration from a person resident in India and carrying out business or non-resident having pay in India doesn't exceed 1 lakh in a previous year. Third, where the payment for the specified service by the person resident in India or the PE in India is not for the purpose of carrying out business or profession. Again, where the payment for the specified service by the person resident in India or the PE in India is not for the purpose of carrying out business or profession. So if it doesn't relate to business or profession, so not applicable. So let us quickly understand and summarize this, when it is applicable and when it is not applicable. Now again, we'll add another category. Service provider has to be non-resident. If he is resident, equalization levy is not applicable. This condition is must. Service recipient or the payer, he should be resident, carrying out business or profession, plus the transaction value should be more than 1 lakh in aggregate during the financial year. Number 2, non-resident having a PE in India plus the transaction value exceeds INR 1 lakh. If there is no business involved, then equalization levy is not applicable. Yes, in case of a non-resident having a PE in India, if that PE is not carrying out business activity, in that case, please note that equalization levy will still be applicable. Usually, PE concept is associated with the business. So it is very remote chance that someone who is having a PE in India is said to be not carrying out a business or profession. So it would be just a theoretical purpose, because if you can see, the language used is that non-resident providing the specified service has a PE in India and the specified service is effective. Okay, sorry. I'm reading the, okay. Yeah. This one, A and B. Non-resident from a person resident in India and carrying out a business or profession. If the payer is a non-resident having a PE in India but not carrying out a business or profession, theoretical answer is equalization levy will not apply. But practically, if you have got a PE in India, you are bound to have a business in India, and therefore the equalization levy would be attracted, provided the other condition, which is transaction value exceeding 1 lakh. Specified service, it covers the online advertisement. Now, what is advertisement? You have any kind of product which you wish to advertise on the internet or on the cloud or on any of the website. The word used is online. It is not advertisement. So, for example, there is any international journal. If you wish to advertise your product in a journal, and that journal is not online, it is distributed to the readers in foreign jurisdiction or in Indian jurisdiction. If there are any publications, if there is a payment to any newspaper like New York Times or any other international newspaper which is circulated offline, not online, then equalization levy will not be attracted. Reason being, it does not have got a nexus with India. All the activities are carried out outside India. So what is important here to note is the word online. Then what do we mean by the term online? Online means a facility, service, right, benefit or access that is obtained through the internet or any other form of digital or telecommunication network. So essentially it means something which has got a virtual presence, not the physical presence. Category 2. Any provision for digital advertising space or any other facility or service for the purpose of online advertisement. So here, the non-resident is owning a platform. On that platform, it gives you a facility to carry out the online advertisement. So in that case, that will also be covered by the definition of specified service. So these two are largely covered. So someone is asking, web push notifications or advertisement? The answer is yes. So these days what happens, take a simple example. When you are logging on to the website of Amazon, the Amazon will use your cookies. Cookies in the sense, wo khane wali cookie nahi. When we log into the website, that website will ask the permission that it will have an access to the laptop, particular features relating to the users. For example, what is the IP address of the user, where the user is located, what are the preferences, browsing history, uh, any kind of information that it can legally access of a user in a particular jurisdiction. Once you allow the cookies, and it asks you another question, whether you wish to allow the notifications or any updates to your website. If you allow that notification as well, you might have noticed that when you are playing a video game on your mobile or laptop, all of a sudden an advertisement will come. So that's a push notification or an advertisement to you. You are a user, you are watching this advertisement, but then on the other side, there is a business organization which has made payment to that website so that that website can push those notifications to the users. Now, whether that transaction is also covered by the equalization levy? Answer is yes. When a user is using a website, he's going through the advertisement, that advertisement revenue is collected by the organization from the third party payers, and that transaction will be covered by the equalization levy, and the payer would be liable to deduct the equalization levy before making payment. So let us move forward. Collection and recovery. Now, as we have understood that the transaction is applicable in a particular scenario, how it needs to be collected, when it is to be deposited, what are the mechanisms of enforcement and recovery of filing returns. So we'll be just briefly discussing upon some of the procedural provisions. So again, as I mentioned, I once again reiterate, the Income Tax Act does not levy or charge the equalization levy. It is the Finance Act 2016 that has a separate chapter altogether dealing with the equalization levy, and that chapter is sort of requiring the taxpayer to comply with the equalization levy provisions. So the collection mechanism is also contained under the separate, but then often you will find the reference to the income tax statute at different places. Provisions of chapter on equalization. Person responsible for deduction of equalization levy. So it's work almost like in TDS provision. Every person being a resident and carrying on business or profession, or a non-resident having a PE in India shall deduct equalization levy as referred to in section 195. So the obligation is again on the person being a resident and carrying on business or profession, or non-resident having a permanent establishment in India. So it is the same as you see, the person who is recipient of service, person resident in India and carrying on business or profession, or a non-resident having a PE in India, then obligation is naturally upon them to deduct that equalization levy before making the remittance. What is the rate? The rate is 6% on the amount of consideration for specified service paid or payable to a non-resident. Specified service, again, the online advertisement or provision of space for online advertisement. In case the amount of consideration is not in exact figures, then it needs to be rounded off to the nearest multiple of 10. Now, this is just for the purpose of ease of computation of levy. Threshold. So as we discussed, if the amount of consideration aggregate payment in a year doesn't exceed 1 lakh rupee, then the equalization levy is not attracted qua that transaction. So this 1 lakh is the threshold provided under the Finance Act. Time limit period for remittance of equalization levy. Now, the levy so deducted during any calendar month, it has to be paid by the 7th of the subsequent month. So, for example, in the month of December, whatever payments I have made to the non-resident, then my liability towards the equalization levy shall be 7th of January. What are the consequences for failure to deduct? So these all provisions are almost or largely in the same fashion as you would have seen the provisions relating to TDS or normal domestic law TDS provisions, where the consequences are for failure to deduct. Then there is a disallowance of expense under section 40AI. So it is on the same line. I'm not getting into much of a detail because you are quite familiar with these provisions. Furnishing of statement. Now, once the tax is deducted, the person who has made the payment, is also supposed to file an information. It is just a statement, or you call it a return, within the prescribed time, that is on or before 30th of the June of the next financial year. So this is to be filed once in a year. You have to file form number 1, as you can see, which is highlighted here, on or before 30th of the June. What is the time limit for filing a revised statement? So in case there are any errors and omissions, then you are given a flexibility. The taxpayer or the payer can file a revised statement, but wait, there is a threshold. There is a timeline. That is expiry of 2 years from the end of the financial year. So for example, for the period April 23 to March, financial year 23-24, the original statement needs to be filed by 30th June. But in case there is any omission or wrong particulars which are contained therein, then you need to file the revised statement, and the time limit available to you shall be 2 years from the end of the financial year. So for March 24, you can file it up to March 26, 31st March 26. Time limit for filing a statement in response to the notice issued by the assessing officer. So I'm not sure whether you have already been introduced the chapter relating to assessment. Now, assessment in simple term, if I just describe, so once we file the tax return or a TDS statement or an equalization levy statement, any kind of compliance that we undertake as a taxpayer, then the department verifies. Department means tax department. They will verify the information from different aspects. It is the assessing officer. Each sort of assessing officer is allotted several cases, and the assessing officer will verify the accuracy of the information. He might have some information which may contradict with what you have already specified in your statement. In that situation, he will issue a notice to the taxpayer to carry out the assessment. And usually that verification, you call it audit, you call it investigation, that is technically called as an assessment under the income tax law or under the Finance Act 2016. So where an assessee, yes, so someone is asking, equalization levy is not a part of an income tax act, and okay, internet connection, no problem. So I'll just spend 1 more minute on this. The Income Tax Statute, Income Tax Act 1961, it provides for the tax on income. So if you earn any income, you have to pay tax, whether you are a resident or a non-resident. As per the provisions of that, you pay the tax in India. In case of a non-resident, as we discussed earlier, if the government amends the domestic law, that is Income Tax Act, they can still take the benefit of tax treaty, that is DTAA. And under DTAA, which overrides or overrules or supersedes the income tax law, you do not pay the tax. For example, I introduced equalization levy under the income tax law. I ask that, okay, this is the threshold of 1 lakh. You collect the equalization levy. And then what will happen? The non-resident will say, hey, look, don't collect the equalization levy. We have a treaty between India and US. And under the tax treaty, India cannot tax this transaction because treaty overrides the domestic law. So government, in its prudence, what they thought, if we introduce this levy as a part of Income Tax Act, then we are not going to get any revenue or benefit out of it. It will just remain a theoretical concept. Rather, let us introduce this levy as a separate act. So every year we have budget. In the budget, finance bill is tabled in the parliament, in the Lok Sabha, and that finance bill, once it is signed by the President of India, it becomes an act of parliament. Now, government said, okay, we will not introduce equalization levy as a part of income tax law. Why? As I discussed, the treaty will override. Let us introduce this as a part of separate law. So it will become part of the Finance Act 2016, which was introduced. Now that Finance Act 16 will have a lot of amendments, a lot of concepts. That amendments were incorporated into the domestic tax law. But the equalization levy provision will still remain part of Finance Act, and that Finance Act will continue to be enforced throughout the journey. So equalization levy is consciously kept out of the purview of income tax law and as a part of Finance Act, so that you cannot take the benefit of tax treaty. You can take the benefit of tax treaty or a DTAA only under the income tax law, not under the GST law, not under the Finance Act. Now, one may ask, why the equalization levy was not introduced as a part of GST? In GST, if you might have come across the concept of OIDAR regulation, that is a destination. So, income tax is a tax on income, it's a direct law. GST is an indirect tax law. It is tax on consumption. It is a destination-based taxation. So in GST, we never had any problem because any which ways import of service is subject to GST, import of goods is subject to GST. So there's no problem there. That law is still there. So they said, okay, we don't want to get into GST. We don't want to get into income tax. Let's bring it separate equalization levy. They could have come out with the Equalization Levy Act also, but they have not done it. They have got part of different act, that is Finance Act 2016. So I hope you were now able to understand the rationale of introducing equalization levy as a part of Finance Act 2016. Coming back to the processing of statement. So any questions so far? I'll just base for a pause just here for 5 minutes or 2 minutes maybe. We'll also see through the questions on portal. Okay, somebody has. Yeah, very, very interesting question. Someone has asked whether foreign party will get credit of this realization levy like TDS credit. If no, then foreign party will get lesser amount of money, means 94% of service value. That's a very interesting question. I'll repeat. So someone is asking whether foreign party, which is non-resident, will they get a credit of this realization like TDS credit? If they do not get credit, whether foreign party will get a lesser amount of money, means 94% of service value. So the answer to this is just come back for a while on the provision. Well, this will be taken care of. Anybody would want to make an attempt to answer this? Any volunteer? Let us make this session interactive. Okay, so someone is saying yes, we'll get a credit. So, okay, no problem. Please understand that equalize how it happens in income tax. If I'm making a payment of, let's say, a domestic transaction, I'm making payment which is subject to TDS under works contract payment. There's a TDS under 194C of 2%. I'm making payment of 1 lakh to somebody. I deduct 2% as a TDS. Now that person who has received the money, he will file his income. He will first compute his profit. Let's say that profit comes to 50,000 and he computes a tax. The tax comes to, let's say, 5,000. And he will take a credit of TDS of 2000, which I have deducted, and net 8,000 he will pay out of his own pocket. That's the end of the story. How it happens in case of a non-resident who has been subjected to equalization levy. So there is a provision, section 1050. We'll just jump onto that and skip the procedural section as of now for a moment. So everything relating to equalization levy is covered under Finance Act 2016. There are some provisions in the income tax law. One of such provision is section 10, clause 50. Section 10, as you all know, it's an exemption section. Section 1050, let us see what does it say. In order to avoid double taxation on account of equalization levy and income tax liability under the provisions of the Act, Section 1050 exempts any income arising from providing any specified service on or after the date on which provisions of Chapter 8 of the Finance Act comes into force and chargeable to equalization levy. Simple. If the transaction has been subjected to equalization levy, then there is a blanket exemption under the Income Tax Act. So we will not look into the transaction, will not see any kind of business connection or any other test. The transaction will be exempt. However, income arising from providing specified service will not include any income which is taxable as royalty or fees for technical service in India under the Income Tax Act, read with DTL, entered into by central government under Section 19. The exemption under Section 1050 is available in respect of amount which have been subjected to EQ levy. However, in case of transaction in respect of which the equalization levy is not attracted, the provisions of Act will apply. So, very simple. If the transaction has been subjected to equalization levy, you don't have to compute your income and tax. You're relieved. Section 1050 gives you an exemption. Your income is completely exempt under the Income Tax Act. So if Facebook is earning ad revenue from India, that revenue has been subjected to equalization levy, no computation of income or tax under the Income Tax Act, because this transaction has already been subjected to equalization levy. Very clear. Now, coming to the question of TDS. TDS is a concept under the income tax law. Equalization levy, although works like a TDS mechanism, there is a deduction, but then deduction is a final tax liability, or not a tax liability, the final levy. So 1 lakh rupee is the amount of payment which I need to make. 6,000 is the equalization levy which I will deduct. Remaining 94,000 I will remit. But then wait, this 6,000 is the final discharge of liability. The assessee, that is a non-resident, is not required to claim the credit and determine his final tax liability. No, this is the final liability and that's the end of the matter. What is the obligation of a payer? The payer has to furnish the statement, okay, I have given this much money to this payer, this payee, this much equalization levy I have deducted and deposited to the government. For payer, there is no obligation as such, no obligation on the part of payer to see anything. Rather, he has been given the exemption from the Income Tax Act itself, Section 1050. But yes, the exemption is limited only in respect of ad revenue. It is not relating to any other revenue, any other income that payee might be subjected to under the Income Tax Act. So yes, question of TDS credit does not arise. Let me ask you a counter question. If a non-resident who has been subjected to EQ levy, 1 lakh was his gross revenue, he paid 6,000 equalization levy by way of deduction. Net amount he received 94,000. His gross income is 1 lakh, but his net received amount is 94. Now, that payer will also file income tax return in his home country, that is United States of America, US. Now, in his home country, when he is computing his tax liability, then the question should come whether the credit for equalization levy, which is paid in India, will that be allowed or not? Anybody want to try? Any guess? Should I repeat the question? Okay, so the student is writing that this is not the income of India person, it is an expense coming to the above party will ask for balance 6% amount because party will not concern to India law. Okay. Okay. So I'll repeat. We all know how the TDS mechanism and tax computation part works when it is an Indian resident to resident transaction. We are all familiar with those provisions. If I talk about the non-resident, in this case, transaction of equalization levy, a person who is an Indian payer carrying out business, he has made a payment of, let's say, 10 lakh rupees to a non-resident. Take an example of Facebook. This transaction has been subjected to equalization levy. So I paid an equalization levy on behalf before making payment to the foreign party, that is Facebook, with the government of India. I filed the statement. Now the question is whether he will get a credit for TDS or credit for equalization levy. Now, as I mentioned, there's a difference. The income itself becomes exempt under the income tax law. So question of credit for equalization levy does not arise. Number two, the equalization levy is different from TDS. TDS works like an advance tax. There is no final determination of tax liability. TDS is just on a gross amount, you deduct some amount as an advance tax deposit with the government, or you deduct the tax at source. Whereas equalization levy is the final liability. There is a specified transaction or advertisement, the EQ levy is deducted. So for a non-resident or, okay, so it is actually on the payer. So for a payer, this is the final liability, but paid on behalf of non-resident. The collection mechanism is on the payer for a convenient point of view. For non-resident, the income itself is exempt under 1050. And on an equalization levy point of view, he has no other obligation because all obligations are on the payer. There is no obligation on the part of service provider. It is the Indian who has to comply with the law. So the question of credit of equalization levy doesn't arise. Now I come to the question. The question is, the non-resident who has received this amount from an Indian user or an Indian business person in his home country, will he be able to claim the credit for equalization levy which was deducted in India? Now the answer to that is, that varies. The immediate answer would be under the tax treaty, credit will not be allowed because tax treaty deals with the income tax. It doesn't deals with the equalization levy. Number two, if he is not able to claim the credit for tax, can he claim it as an expense? Now that again depends upon the domestic law of the foreign country, whether that foreign country will allow the credit for expense or not. So any which ways, this is just for theoretical discussion. So that depends upon the domestic law of the foreign country, which is not sort of subject matter of detailed discussion today. It varies from country to country. So just to sort of satisfy the curiosity of the students, in case of Ireland, Ireland has sort of came out with a notification providing that if an Ireland company is subjected to EQ levy in India, the EQ levy will be allowed as an expense deduction. Just like we have section 37 in India, in Ireland, it will be treated as a business cost and allowed as a deduction against the profits. So someone is writing that had it been allowed to give credit, then it would have been motivating source to pay levy. That's true. Right. So someone is correctly mentioning that it depends on their country's tax law. It may be DTAA, foreign tax credit, or it may be under the DTAA. Largely, it's not a unilateral step, it's a bilateral, but some countries might allow it. Now, coming to one important aspect. So there was some ambiguity. So they are clarified under section 1050. So in Income Tax Act, okay, wow. So someone is asking, does it get impacted by MFN status? So MFN, you will have a separate discussion, but to answer it, as of now, no. This transaction of equalization levy is out of purview of tax treaty. So MFN will not impact the levy of equalization levy. But you will have a separate session dealing with the tax treaty and MFN. So I'm not, in the interest of time, getting into those sort of niceties. Let's say, for example, the same payment which I'm making to the non-resident, can it at all be classified as a technical fees, or can it be classified as a royalty? Now, so far as the royalty is concerned, the answer is straight away no, this payment cannot be classified as a royalty. But there are chances that at times when you are making a payment for an online advertisement or provision of space for online advertisement, under the domestic law, that transaction may be subjected to tax as a fees for technical service. Now, the government has clarified under section 1050 of the Income Tax Act that income arising from providing specified service will not include any income which is taxable as royalty or fees for technical service in India under the Act, read with the DTAA under section 90. So if the transaction has been subjected to FTS or royalty, then that will be out of purview of the equalization levy. There might be situation where there is an overlap. So that is why this safeguard is being built into section 10. What if the payer fails to sort of deduct and collect the equalization levy? Then the consequences are prescribed under the Income Tax Act. If I have availed services from Facebook towards advertisement, I have made payment and I'm failing to deduct the TDL equalization levy, then section 40A clause IB would be attracted, and this transaction or this expense in my books would be disallowed. And just like the other provision 40AI or 40AIA, the same expense will be allowed in the year in which I have deducted as well as the paid. If I have deducted, but if I have not paid, again in that situation also, the expense will be disallowed. The advertisement cost in my books will be disallowed. It will be allowed in the year in which I make the payment. So we are not getting into detail in relation to this provision as of now. So let us come back to the procedural aspect. Okay. So before moving to the procedural aspect, let us quickly summarize this. I hope it is visible. Yeah. Any other questions? Someone has written, does it get impacted by MFN soft rate? Any other question? We'll just pause here for a moment. You can go through the slide in the meanwhile. This is just recapitulation of discussion we had. Yes. So there's one question. I have old study material. Is there any amendment in recent budget relating to levy chapter? Yes, there is an amendment. So the equalization levy was introduced by Finance Act 2016. The scope of equalization levy is restricted, as you can see to online advertisement, digital advertisement space, or any other facility for online advertisement. Now, this only covers Facebook, LinkedIn, YouTube, or all those organizations which are sort of providing the online advertisement facility on their platform. What about other companies? Take, for example, Netflix again. If you make payment to Netflix for advertisement on its portal, that is covered by equalization levy sorted. But as a user, when I'm paying subscription fees to the Netflix for watching the sort of videos on its website, or if I'm subscribing to the YouTube channel and I'm making payment to YouTube, if I'm watching any video on an online television broadcasted by a foreign company, what about them? They are not advertisement. For them, it's simply a revenue. By Finance Act 2020, Finance Act 16 was amended. In Budget 2020, the Finance Act 16 was amended, and the Equalization Levy 2.0 was introduced, popularly called as 2.0. But then that was introduced to tax the transactions relating to e-commerce supply or service. Let us spend 2 minutes on them, on those provisions. I'll just, for the reference of all the students, will open it for a moment. Now that is not a part of syllabus. Under the new module, you will see equalization levy on e-commerce transaction is not there, because in the recent budget, which was like in July or August somewhere, that budget has sort of completely omitted or repealed the provisions relating to equalization levy 2.0. So we have equalization levy introduced by Finance Act 16 that is still there, but the equalization levy 2.0 that has been omitted, that is section 165A, which you can see on the screen. Now this provision has been amended. So quickly, I'm just summarizing for your academic interest. This is not a part of a new study material that has been launched very recently for May 25 students. So this was introduced. So as you can see, I've mentioned it has been discontinued. So what was the transaction? Yeah. So earlier there was no separate provision to tax the e-commerce operator like Amazon, Alibaba. There are a lot of foreign companies you make payment to for purchase or import of goods, or for watching YouTube videos. You download games on App Store, Play Stores. So all these transactions were not getting taxed in India because these companies never had any kind of permanent establishment in India. So till March 2020, it was all fine. It was not taxable. But then from April 2020, a new provision in the form of EQ Levy 2 came into picture, where the e-commerce operator, now you see the term is very wide, e-commerce operator, he was made liable to pay 2% on the amount of consideration received or receivable by such e-commerce operator from e-commerce supply or service made or facilitated by it or deposited with the Indian authority. To whom was it applicable? When the payment was made by a person resident in India or a non-resident from sale of ad which targets customer resident in India or customer who access the ad through IP address located in India, sale of data collected from a person resident in India or a person uses IP address located in India, or to a person who buys goods or service using IP address located in India. So if a resident person is making payment to a non-resident e-commerce operator, take for example Amazon, for purchase of goods or purchase of services, that transaction will be taxable in India and e-commerce operator will be liable to pay 2%. Again, equalization levy, not the income tax. Now that provision has now been omitted. Equalization levy section 165 capital A, which was introduced by Finance Act 2020, Now, this has been repealed with effect from 1st August 2024. So, under the new syllabus, this provision will not find its place. But yes, under the old study material amended by Finance Act 2023 or Finance Number 1 Act of 2024, that material might contain equality provisions. Equality 1, which we just discussed, that is still there, and it is part of the Equalization Finance Act 2016. It is in place and as well as a part of the syllabus. Any other question? Yeah, so if you have got October 23 edition, then Finance Act 2023, so that this EQ Levy 2 has been omitted from Finance Act 2024 August onwards. So yes, definitely it would be part of material, but it is not a part of statute anymore. So let us continue on now the procedural aspects. So we have covered the time limit for filing revised statement, processing of statement. So once you file the statement, that statement will be processed for arithmetical errors, if any arithmetical error. The system itself usually computes, or the assessing officer, in case there is any interest for shortfall. If there is any refund due to the assessee, in case of any excess deposit or payment, that same will be granted. So there is a timeline. That processing should happen within 1 year from the end of the financial year in which the last revised statement was filed. In case it is not, in that case, the intimation cannot be issued or the processing cannot be undertaken by the tax department. So there is a complete procedure prescribed for the assessment, the assessing officer. So, okay, while the act is different, the administrative machinery, it is the same income tax department which will administer this law, and the assessing officer will also be a part of an income tax department who will do the assessment. Rectification of mistake. So just like we have section 154 under the income tax law, on the same lines, if there is any kind of rectifications, in case there are any kind of rectifications, then the same can also be undertaken either suo motu or upon intimation by the assessee. So this is just, self-explanatory. So I'm not spending much time on this. So you can. So someone is asking, what is the benefits to the Indian taxpayer for implementing the equalization levy? So see, as we mentioned in the beginning of this session, the equalization levy is primarily for the non-resident service provider. It is not for the Indian service provider. If the person is resident in India, any which ways his income is going to be taxed in India. So there cannot be a question of, he getting becoming a tax evader, or he is not complying with income. It is only when a non-resident operates through remote location, it becomes very difficult to tax those transactions. And therefore, this equalization levy and the obligation is cast on the person who is resident in India to comply with that law, because it is only a payer who can deduct the tax or a levy at the time of payment. So there's no question of benefit or a loss to the Indian resident, because Indian resident, any which way he was going to make an entire payment, and now instead of making an entire payment, he'll just make a withholding in the form of EQ levy and deposit with the government. So he's neutral. But yes, many a time the foreign companies would insist that we are least bothered about the taxation in India or EQ levy. The payment that is to be received by me has to be on the basis of grossing up basis. I'll receive the entire payment. You bear the equalization levy in India. If the contractual arrangement is such, then yes, the Indian taxpayer would be incurring a cost to the extent of EQ levy. Interest on delayed payment of EQ levy. If the levy is not paid within the time prescribed, which is 7th of the subsequent month, then 1% per month would be the interest cost. Penalty for failure to deduct or pay the equalization levy. Now, this is very interesting. If there is a failure to deduct either whole or part of the equalization levy, then the interest cost is, of course, there, which is compensatory in nature. The penalty that you have to pay is equal to the amount of levy that you have failed to deduct. Now, this is on the deduction. If you do not deduct, then the penalty is up to the amount of equalization levy. Then comes failure to remit the equalization levy. In case as a resident or as a non-resident having pay in India, I have deducted the equalization levy. I have kept that money with myself, but I have not deposited. Then the penalty would be 1,000 for every day during which the default continues. So this is already highlighted. Now, please bear in mind both the penalties are different. The first one is failure to deduct whole or part of equalization levy under 166. So there is no deduction at all. Forget about the question of deposit. I have not deducted at all. Then the government says, okay, beta, if you have failed to deduct, then pay the penalty equal to the amount of equalization levy that you will be called. Because failure to deduct would invite the amount equal to the equalization levy. If there is a deduction, but then there is a failure to remit, that is remit, meaning thereby I have deducted, but I have not remitted to the government. In that case, in addition to paying the equalization levy specified under 166(2) and interest under 170, a penalty of 1,000 for every day during which the failure continues. So 1,000 per day. But wait, there is a catch. So the amount of penalty at all does in any case will not exceed the amount of equalization levy that may be subjected to pay. For example, if my liability to pay equalization levy is, let's say, only 1 lakh rupees, and the penalty is which is 1,000 per day, and there's a delay of 200 days, then that comes to 2 lakh rupees. I will not pay the penalty of 2 lakh. The liability towards penalty will be restricted only to the extent of equalization levy, which is 1 lakh. Then there's a penalty for failure to. Yes, penalty provisions are stringent. Penalty for failure to furnish the statement. In case I deduct the equalization levy on time, I paid it on time, but then there's a failure to furnish the statement within the 30th June of the immediately following financial year. In that case, the penalty is, as is highlighted, it is 100 days during which the failure continues. So it is more of a fee rather than a penalty. Just like you have section 234E, if there's a delay in filing the TDS return or TDS statement, you have got to pay 100 per day. So when the penalty will not be levied, there will be no penalty for failure to deduct or pay equalization levy or failure to furnish statement if the assessee proves to the satisfaction of the assessing officer that there was a reasonable cause for the said failure. So if there is a reasonable cause, then there is no penalty. No order imposing penalty under this chapter shall be made unless the assessee has been given a reasonable opportunity of being heard. Now, this is a principle of natural justice. Even if this provision is not contained in the statute, even in that case also, every quasi-judicial authority is required to provide an opportunity of being heard before imposing any penalty or taking any adverse action. In any case, if you are able to establish a reasonable cause. Now, what is reasonable cause? Now, this is not defined under the income tax or under the Finance Act 2016. Reasonable cause could be anything which is a bona fide reason. Say, for example, if you fail to comply with the equalization levy, you did not pay the equalization levy for reasons such as there was a fire in a factory, all the accounting records were destroyed. Number one, that's a reasonable cause. If you are incurring consistent losses and you are being subjected to insolvency proceedings and you are left with no cash liquidity or funds with yourself, then yes, that's a reasonable cause. The courts have held. So these are just instances. It will depend upon the situation to situation. Now, say for example, the assessment is done. Okay, so I think should we take a break of, before discussing the appeal, let us take a break of 10-15 minutes. Ajiji, is it okay? 10 minutes? What is the usual time for break? 10 minutes? Okay, all right. So we'll deal with the questions that we have posed, other questions, and we'll continue after 10 minutes. We'll pause here. back to equalization levy chapter. We'll just touch upon briefly. Now we are almost concluding the equalization levy, and then we'll move gradually after 5 minutes to the taxation of virtual digital assets, that is crypto transaction. Appeal mechanism. So like in any revenue law, there are always disputes between the assessee taking X position, department taking Y position, assessing officer making adjustments, raising demands. It can be any issue. So there are appeal mechanisms, appeal remedies. The first appeal under the income tax law is the Commissioner of Income Tax Appeal. Now, equalization levy is a small piece of legislation, although it is not part of the Income Tax Act, but yes, it is closely connected with the Income Tax Act. As we saw previously, the exemption is given under Section 10, Clause 50 from the levy of income tax in relation to a transaction which has already been subjected to equalization levy. And therefore, since it has got a close connection, the administrative machinery to enforce the equalization levy provision is no one but the income tax department. It is the Central Board of Direct Taxes. So as we mentioned, the assessing officer and their role, now we'll touch upon the role of the appeal Commissioner of Income Tax Appeal. So it is the same CIT appeal who administers the sort of deals with the appeals first as an first appellate authority relating to income tax matters. He is only going to administer or deal with the appeals relating to the equalization levy. So if there is any order passed by the assessing officer under the Finance Act 2016 and assessee is aggrieved by the order passed by the assessing officer, he may file an appeal before the Commissioner of Income Tax Appeal within 30 days from the date of receipt of order. Please note that the appeal can be filed only when assessee is aggrieved by an order imposing any penalty under this chapter. Filing of appeal. Now, fees is same 1,000. So under the income tax law, we have different fees like 500, 250, 1,000, and in relation to penalty matter, there's a 1,000 fee. Under the Finance Act 2016, again, the fees for filing of appeal is kept flat 1,000, and the appeal needs to be filed electronically on the income tax portal. Again, please note there is no separate portal for equalization levy. It is the income tax portal only, incometaxindia.gov.in. That is the portal through which the appeal needs to be filed. The provisions of the Income Tax Act applicable in case of such appeal. Where the appeal has been filed, all other provisions relating to the appeal mechanism prescribed under the income tax statute will equally apply to the appeals in relation to the equalization levy. Second level of appeal, appellate tribunal. Let us say you have been adjudicated at the Commissioner of Income Tax Appeal level. Either you may have won the matter, or demand may have been directed to be deleted, or penalty may have been directed to be deleted, or alternatively, the order may be against you. Either of the situation. If it is in your favor, the department may file an appeal before the Income Tax Appellate Tribunal. If the order is not in your favor, then the assessee, taxpayer, can file an appeal. With whom do we file the appeal? It is the Appellate Tribunal, that is Income Tax Appellate Tribunal. Again, the time limit for filing of appeal, double, that is higher than the time limit available when you file an appeal before CIT appeal. As against 30 days, you get 60 days when you want to file an appeal before tribunal. Please note that even for the income tax matter also, the time limits prescribed are common. You have to file appeal before ITAT in relation to income tax matter, which is 60 days. Fees, flat fee of 1,000. Also, the form of appeal, grounds of appeal, form for verification of, etc. They are to be signed by the person who is authorized to sign the form number 4 as applicable to the assessee. Now, all these are procedural aspects, and you will have separate session dealing with the assessment and appeals under the income tax statute, maybe in the month of January or February, where these provisions will be, dealt with in great detail with a lot of judgments that have been rendered and the principles that have been established. So right now, in the interest of time, we are keeping it very brief discussion here. So I think the form 35 is under the income tax. Someone is asking, it is form 35 under the Income Tax Act for CIT appeal. Yes, you are right, if it relates to income tax matter. But if it relates to equalization levy, then the form for filing an appeal under the Finance Act 2016 is different, and the authority before whom you have to file an appeal, it would be same. That is the Commissioner of Income Tax Appeal. So the mechanism and manner, everything is same. Mechanism of adjudication. So whether it is the income tax law or any other revenue law, there are always the appellate authorities. The forms might be different. So under the income tax and equalization levy, the appellate authority is same. Punishment for false statement. So again, if the person is making a false statement in a verification under this chapter or any other rules, or he delivers on account of statement which is false, then if it is a willful default, in that case, the punishment will also be along with the penalty, and the punishment would be an imprisonment for a term which may extend to 3 years, and also fine. Please note that it is not or fine, it is and. So there will be a fine as well as a punishment. There will be a fine as well as the prosecution. That is an imprisonment for a term which may extend up to 3 years. Institution of prosecution. Now, prosecution proceedings can be instituted only based on the sanction or the approval of the Chief Commissioner of Income Tax. So again, under the income tax law also, if there is a default in, let's say, payment of TDS, or if you make an incorrect statement, or if you fail to furnish the return, or if there is a case of tax evasion, the assessing officer may initiate a prosecution proceeding, but he can launch the prosecution only upon receipt of approval from the commissioner, Chief Commissioner of Income Tax. So likewise, under the equalization levy law also, the institution of prosecution will happen by the assessing officer, but then it will require the sanction of the Chief Commissioner of Income Tax. So this is again informative. There are certain provisions of the income tax law which would equally apply to the administration of equalization levy law. Like for example, section 119. Now 119 authorizes the Central Board of Direct Taxes to provide instruction to the tax officers in relation to the administration of the income tax law. It also authorizes the chief commissioners and the Central Board of Direct Taxes to grant the relaxation from rigors of the income tax law wherever there are bona fide cases or technical breach of law. So all these provisions will equally apply. Now, say for example, under the income tax law, the due date for filing the income tax return is 31st of July or 30th of October, whatever it is, based on the different class of taxpayers. If I fail to file the return, there's a provision that provides me to file the belated return of income or even the updated return of income upon payment of taxes. Take up a case where the assessee could not file the return of income and there is a genuine difficulty or there is a bona fide case in failure to file the return of income. What he does, he approaches under section 119 of the income tax law to the chief commissioner or the Central Board of Direct Taxes to condone the delay in filing the return of income. And likewise, for any kind of difficulty, any kind of non-compliances which are genuine and bona fide, the condonation application is filed before the CBDT under 119. Now, there is no separate provision prescribed under the equalization levy related provisions, that is Finance Act 2016. The same Income Tax Act, section 119, will equally apply in administration under the equalization levy. And likewise, there are other provisions like power to conduct search and survey, disclosure of information relating to assessee under section 138, the provision for issue of demand, recovery of demand, recovery of tax, penalty, interest. So all kinds of provisions which are already prescribed under the income tax law, the same provisions will equally apply to the administration of equalization levy. So likewise, under section 260, capital A, 261 and 262, you have got a right to file an appeal, a tax appeal before the High Court or Supreme Court. Let's say if the matter is decided against the assessee by the tribunal, he can file an appeal before High Court or Supreme Court under the income tax law. So likewise, under the equalization levy also, the same section will apply and you can appeal before the High Court and Supreme Court. So this is just informative purpose, it is kept. Each of these individual sections, there would be a separate session, live virtual class for that, and you would be taken through those, what is the meaning of cognizance of offense, what is the meaning of appearance by authorized representative, what is the meaning of service of notice generally, code of criminal proceedings application. So all these provisions will be dealt with in a separate session. So in the interest of time, we have just kept it here, but then not discussing much in great detail as of now. Power to make rules. So to remove any difficulty, the central government is empowered to make rules for the purpose of carrying out the provisions of this chapter. In particular, the rules may also provide for following, like for example, the time within which, the form and manner in which the statement needs to be delivered, the form in which an appeal may be filed that has already been prescribed, or any other matter to remove the hardship of the provisions. So the government has been notified. So this we have already done. This is a brief summary. So again, equalization levy applicable at the rate of 6% on the amount of consideration. It is applicable provided specified services have been rendered by non-resident. The specified service has been defined to include the online advertisement service or provision for online digital advertisement space or any other facility or service for online advertisement, or third category, any other service notified by the government. Nothing has been notified as on date. Non-resident not having PE in India or providing service not effectively connected with his PE in India. So the person who provides the service should be non-resident and he should not have a PE in India. The moment the non-resident has got a PE in India, so as we discussed earlier, the activity is carried out in India, and then the PE, of course, is a legal presence in India, separate presence in India. So the question of equalization levy doesn't arise because his profits are already taxable in India in the hands of permanent establishment. Who should be service recipient? A person or the payer, the person resident in India carrying out business or profession, or a non-resident who has got a PE in India. That is, some kind of nexus is required. Whether the amount of payment in aggregate during the financial year exceeds 1 lakh, answer is yes, equalization levy is attracted. If no, then EQ levy doesn't attract. Then what are the consequences? So as we discussed, the person is liable to deduct EL and he has to deposit within 7th of the month. If there's a delay, there's a 1% interest payment, 1% per month. 1% per month. Penalty, again, equal to the amount of equalization levy, the penalty. In case there is a deduction, but then there is no deposit or there is no remittance to the government, then the penalty is 1,000 per day for a failure. Plus, in addition to that, the entire expense will be disallowed and it will be allowed in the year in which you actually make the equalization levy payment. Now let us spend almost 45 minutes on the taxation of virtual digital assets, and some of the questions then we'll address in the remaining 15-20 minutes. Are there any questions relating to equalization levy before we move to the next topic? If there are no questions relating to equalization levy, if there's a complete clarity, we can move to the taxation of virtual digital assets. If there is any question, we can ask now, or otherwise once we complete the taxation of virtual digital assets. All right, so I feel there are no questions. So with this, let us move to the taxation of virtual digital assets. So you all might have heard the word cryptocurrency. You might have heard the word Bitcoin, Ethereum, Wazirex exchange. So anything that we want to buy or as a sort of consideration, what we pay is the money. Money is a legal tender, and that is sort of tendered by the government, a legal tender. Cryptocurrency was coined somewhere in between 2007 and 8. And then eventually, as you have seen over a period of last 12, 13 years, it has gained so much of popularity for various reasons. Of course, it is not a legal tender. It is not yet authorized by a majority of the countries. In some of the countries, it is accepted as a legal tender. In some of the countries, yes, it is not a legal tender by RBI. It is specifically clarified that cryptocurrency, yes. So there is a history attached to it. We'll come to it. But then, yes, it is not a legal tender. It is only the money that is legal tender in India, and likewise in other countries also. The virtual digital asset or cryptocurrency is not sort of recognized as a legal tender. There are very few countries, particularly the island nations, where this has been done. But then again, only the future will tell whether it is going to be accepted as a legal tender or not. Finance Act 2022. The government introduced a separate mechanism to tax the virtual digital assets, that is the crypto transaction, which are undertaken through the blockchain technology. What was happening in 2016 and 17, on various occasions, RBI as well as the government of India, they issued the advisory, some press releases, cautioning the Indian residents against usage of virtual currency. They said that this is not a legal tender. While there is no law which explicitly stops you from carrying out the transaction of virtual digital assets, nor there is a law which explicitly allows you. So the government was silent on this, and even till today, there's the same position. There's no law which regulates or allows you. There's no law which expressly prohibits. But yes, there was a caution note to ensure that there are no frauds in India and likewise in other countries. But then lot of people, more than, there's a news that more than 200 billion, that means 20 crore plus individuals and organizations, they had started using crypto. There were a lot of exchanges and platforms which were launched across different countries to exchange the cryptocurrency. The value of cryptocurrency got inflated to an astronomical figure from $1,000 to $1 lakh. Today, Bitcoin is around $1 lakh. So a lot of people started using cryptocurrency as a money-making exercise, as an investment, as a trading, or as a speculation means. Some of the websites started even accepting cryptocurrency as a form of payment. A lot of US companies had also started taking cryptocurrency as one of the mode of accepting money, as a mode of accepting the value in exchange of product that they deliver. So the government thought that, okay, while we are still working on the mechanism and drafting the bill, coming out with a law dealing with the cryptocurrency, in the meantime, that there was a complete ambiguity about the taxation of cryptocurrency. Under the income tax law, while Section 2 defines the income, and the definition of income is quite wide, so as to include even the gains arising from the crypto, it is not expressly mentioned, but the definition is inclusive. And the transaction was definitely taxable under the erstwhile law also. But then in some sections of the society, there was a school of thought that the taxation from sale of crypto asset is not taxable. It is a capital receipt. And there was some ruling also which excluded the sort of, they gave the protection against taxation under the income tax law. So then the government finally came out with an amendment, significant amendment, a new section 115 BBH and section 2 clause 247A was introduced in the income tax law. Thereafter, there were certain notifications which came to be published or notified by the government, as well as the circulars. Section 194S for deduction of TDS by the buyer before making payment towards purchase of crypto, that was also introduced. Let us try to understand the meaning of virtual digital assets. So they have coined the new word virtual digital assets for taxation of these digital currency transaction. 247A. Section 2, clause 47A is what we are going to read, which defines the taxation of virtual digital assets. What it means? Virtual digital asset means any information, code, number, token, which is generated through cryptographic means or even otherwise, which provides a digital representation of value which is exchanged with or without consideration, with the promise or representation of having some value, which functions as a store of value or a unit of account, including its use in any financial transaction or investment, but not limited to investment scheme. It is different from the investment scheme, which can be transferred, stored, or traded electronically. So the key features, as you can see, that virtual digital asset is nothing but it can be an information. Number one, it can be an information. It can be a code, it can be a number, or it can be a token. But certainly, it cannot be a currency or a foreign currency. It cannot be a legal tender. Legal tender, whether in a digital form or in a physical non-digital form, that is not a virtual digital asset. Indian currency or foreign currency are a legal tender, as somebody rightly highlighted here. It is an information, code, number, or token. Clear? Now, this information, code, number, or token is generated through cryptographic means. Cryptographic means it has been in an encrypted form, that is in a secret form, confidential form, and protected form. It has certain value, inherent value, and it can be transferred. It can be transferred, stored, or traded electronically. It cannot be transferred, stored, or traded non-electronically. The moment you call it non-electronically, it is not a crypto. It has to be virtual, it has to be electronic, and it can be stored also electronically, cannot be stored physically. You cannot keep it. You cannot sort of store it. For trading purpose also, you have to undertake the activity electronically. So all these features are found, then it is called as a virtual digital asset. Then even a non-fungible token or any other token of a similar nature, that will also be called as a virtual digital asset. Now, non-fungible, so that means something which has, what is code? Code, okay, so someone is asking what is code? Code is, something which is, how to explain? Okay, so take for example, you have your mobile number. If I want to transfer money in your bank account, you have a code which is your bank account number. If I want to make a payment to you through mobile transfer or payment gateway, there are different options. I can use your UPI ID. I'm just explaining it in a layman terms first. I can transfer it to you through your UPI ID. I can transfer that through your mobile number, which is linked to your bank account. I can also transfer it through a scanner. Now, scanner is what? Scanner is a digital representation of your bank ID and mobile credentials. That is in an encrypted form. One cannot read it. It is completely secret. One cannot decipher the information completely from the scanner. Scanner is a digital representation or a code representing certain information in an encrypted form. Now, a very open-ended definition. It says, ideally, the core or essential feature of a virtual digital asset is that it has been generated through the cryptographic means. That means in an encrypted form. But then the government here is mentioned in section 2, clause 47 or otherwise. Now, this is very subjective. If an information is generated through cryptographic means, yes, understood, it's a virtual digital asset. But what do we mean by the term otherwise? If I have generated some number which is not encrypted, Can you still call it as a virtual digital asset, provided it satisfies the other information, other conditions? For example, it is having a store of value unit of an account, it can be transferred. If these features are there, then even in a non-encrypted form of a cryptocurrency can also be called as a virtual digital asset. Thereafter, there was a provision that central government may by notification exclude the digital assets exclude any digital asset from the definition of virtual digital asset subject to certain conditions. A notification was issued by the central government, notification number 74 2022. There are certain, we will deal with the questions. There are certain assets which may satisfy the definition of virtual digital asset provided under section 2 clause 47A. However, they have been explicitly carved out or given an exemption from being within the purview of virtual digital asset. What are those exemptions or exclusions? Number one, gift card. You can simply go to Amazon, Flipkart, or any other website, pay the money or money's worth, download the gift card, give it to someone else. That gift card can be used for purchase of assets as specified in the gift card through a login or website. You can give gift voucher to your employees. Now, all those vouchers, gifts, they to some extent satisfy the definition of virtual digital asset because of the usage of the word otherwise. But in any case, the government has consciously kept them out of the purview of virtual digital assets. Mileage points, reward points, loyalty card. You go to Tata store, you buy some stuff, then you are given a reward. You go to any other Reliance Smart or whatever it is, you purchase, let's say, a particular threshold worth of goods. In that case, you are given certain reward points, and you can use those reward points, or you can transfer those reward points. You can store those reward points with you in a digital form, and you can exchange it for either money or cashback, or by purchasing any other goods or merchandise that you would want to purchase. So they have got a transferability feature. Yes. They are stored in a number or an information. Yes. They have been encrypted. Yes. Whether they have got value. Yes. So all these features are satisfied, but then consciously government has kept them out of the purview of the definition of virtual digital assets. And likewise, any benefit, royalty, incentive, rebate, or promotional program that will be used or redeemed only to obtain goods or service or a discount on goods or service. Similarly, subscription to website, platform, or application. If I buy a subscription of Disney Plus, Hotstar, Netflix, or any other channel, I can transfer that subscription to you. That subscription will have certain passwords, keywords that has a value. Yes, during a tenure it can be used, but that doesn't have an indefinite value. It can be a lifetime subscription also. So all these aspects have been kept consciously out of the purview of virtual digital asset taxation. Now, what are the implications? Once an asset is classified as a cryptocurrency or a virtual digital assets, the taxation mechanism is provided under Section 115 BBH, 115 BBH. What does the section says? Tax rate on transfer of virtual digital asset. Where the total income of an assessee includes any income from transfer of any virtual digital asset, such income will be taxed at the rate of 30% under Section 115 BBH. So this is a flat rate prescribed. Over and above, the surcharge and education says as may be applicable will be there. But then there's a flat rate of taxation, and this rate is applicable provided there is a transfer virtual digital asset. So for VDA, you have to see Section 247A. For transfer, it doesn't say any profit. It says first there has to be a transfer. No deduction. In computing the income from transfer of virtual digital asset, no deduction would be allowed under any provision of the Act. Now, say for example, I am owning one Bitcoin. One Bitcoin is equivalent to, let's say, $106,000 today. I bought it for 1,000 in 2015. Bought it for 1,000, selling it for 1,05,000. There is a net gain of 1,04,000. 1,04,000 multiplied by 30%, that is the tax. Flat rate on transfer of virtual digital asset. Now, say for example, I have bought it through an international exchange, which is charging me the commission at the time of purchase as well as at the time of sale. I have invested in the Bitcoin by taking borrowings from the bank. Let's say I had invested $1,000. I borrowed the $1,000 from the bank. Now, on those borrowings, I have been paying the interest each and every year till today. And then I have sold it. Again, no deduction will be allowed. The section explicitly says that in computing the total income, no deduction would be allowed under the provision of the Act in respect of any expenditure or allowance except the cost of acquisition. So as I mentioned earlier, 1,05,000 is a sales consideration. Purchase consideration is $1,000. Net $1,04,000 will be my gain, which will be subject to tax. Now the question arises, under which head of income I have to offer this profit if I have earned the profit. So see, section 115 BBH only provides for the special rate of tax. 115 BBH does not prescribe the head under which the income will be taxable. Even otherwise also, any income, let's say for example, in case of a dividend income, there is an explicit mention under section 56 that the dividend shall be taxable under the head income from other sources. In case of house property, it will be taxable under the head house property. In case of salary, it is taxable under the head income from salaries. In case of a transaction in relation to the virtual digital assets, the taxation is largely governed by the nature of the transaction. If I have held the virtual digital asset as an investment, then of course the transaction will be treated as a capital gain, chargeable to tax as a capital gain under the head capital gain or loss. If I am a trader, I am into the business of dealing the cryptocurrency or virtual digital asset, then as a businessman, I'll select the PGBP as my head of income. The income would be computed under the head PGBP. If I do not fall in either of these categories, then of course income from other sources also there. But then yes, there is a lot of ambiguity. There are no rules as on date. There are only schools as on date, different schools of thought, and based on the accounting concept as well as based on the sort of a type of a transaction, frequency and volume of transaction, one will have to select the head. But yes, as I mentioned, there is nothing which is prescribed explicitly under either head of the income as to whether this transaction will be taxable in that head of income, except in one situation. We'll come to it later. Set off and carry forward of loss from transfer of virtual digital asset is not allowed. Now, this is very serious. Loss from transfer of virtual digital asset, it will not be allowed to be set off against income computed under any provision of the Act to the assessee, and such loss will not be allowed to be carried forward to subsequent assessment year. So if I have incurred a gain that is taxable, if there is a loss, I cannot set off this loss against any other income. I cannot carry forward this loss. Even the reverse is also there. If I have earned a gain and from transfer of virtual digital asset, and at the same time, I'm also carrying out any other business activity, or I have got a capital loss under the head capital gains, can I set off? The answer is no. So in both sense, it is an independent section. 115 BBH is a special section. No loss is allowed, no deduction is allowed. Deduction only in respect of cost of acquisition. Now the question comes, what is the nature of virtual digital asset? Is it a tangible asset? No. Is it a financial instrument? No. Is it an intangible asset? Probably yes, while the law is silent, but yes, probably it almost satisfies all the features of a typical intangible asset. It has a value. It can be generated, self-generated through mining. It cannot be seen. It is an intangible asset which can be owned. Now the question comes, under the Income Tax Act, what is the cost of acquisition of an intangible asset? For the purpose of computation of capital gain, Section 48 is there. If it's a case of a business taxation, then Section 43C defines the cost of asset. In either of these situations, the value of an intangible asset is always taken to be nil, unless it is an acquired intangible asset. So if I acquire a virtual digital asset, then yes, I have got a cost at which I have acquired and readily I have purchased it. That is taken to be the cost of acquisition. But if I have not acquired it, I have generated it, because the asset can also be self-generated by undertaking the data mining, code mining through electronic means and surfing. If that is the case, then often the question arises, can this cost be allowed? Now, there is no express mention about the allowance or disallowance of data mining cost under the provisions of the law. The section is very clear. 115 BBH simply says that except cost of acquisition, no other expenditure will be allowed. What is cost of acquisition is not defined under 115 BBH. So under the normal principles of law, if the cost of acquisition is not defined under the 115 BBH, I will look for where is it defined. Under the capital gain head, the intangible asset cost is taken to be nil unless it is an acquired asset. So we have a clarity. Okay, if it is self-generated, cost will be nil. If it is acquired, cost would be acquisition cost. In case of a business head, same concept will follow. If it is an acquired asset, then cost of acquisition would be your purchase price. In case it is self-generated, then there is an ambiguity. There is a wonderful decision of a Gujarat High Court in one of the cases relating to valuation of an intangible asset, which is self-generated. The Gujarat High Court in one of the cases, if you wish to note, Mohan Bhai Pamabai, wherein the High Court and the judgment is also sort of upheld by the Supreme Court in the reported decision 165 ITR 166 1987. So what they say that anything that you incur to bring the asset to its present form, any kind of cost, that can be taken to be the cost of acquisition. Now that principle was not in relation to the crypto asset, that was in relation to something else. But yes, arguably that principle can be followed. But yes, the law is silent, there's a debate and litigation is going to be seen in the times to come. Virtual asset need not be a capital asset. While there is a usage of the word transfer under 247, but the same in relation to the virtual digital asset is different. It need not be a capital asset always. So this we have already discussed. It can be taxable under IFOS as well as a business act. Taxability of receipt of VDA as a gift from individuals for inadequate consideration from individual or anybody else. So we have Section 56 under the Income Tax Act. What does Section 56(2)(10) says? In general, it says that if you receive any property without consideration or for a consideration which is inadequate, and the transaction value or the amount of consideration in the benefit, the benefit exceeds INR 50,000, the difference between the consideration and the actual fair market value. If that exceeds 50,000, then that is going to be taxable receipt in the hands of a recipient at the fair market value. In case of a VDF, that is not specified as a specific property under the 56(2)(10), which defines the term property under 56(2)(7). So the amendment has been brought specifically under 56(2)(10) by the Finance Act 2022, wherein the definition of property has been amended through an explanation where the property shall also now include the virtual digital asset. If the virtual digital asset, that is a crypto asset or any kind of digital asset, non-fungible token or otherwise, they have been acquired by any resident without consideration, the fair market value of which exceeds 50,000, or for inadequate consideration, and the difference between consideration amount and fair market value is more than 50,000 rupees, then that amount will be taxable in the hands of recipient. Now, please don't get carried away by the fact that because there is a reference of virtual digital asset under section 56 to 10, that means the income will be exclusively taxable under the head IFOs. No, that is not true. 56 to 10 only deals with the transaction where the property or money's worth has been acquired without consideration or a gift transaction. It does not characterize or at any point of time decides the mechanism of taxing the transaction of virtual digital assets. Now the question comes whether the provisions which are like other provisions contained in 56 to 10, like gift received upon death of a person in contemplation of death or as a gift or upon marriage, whether those provisions will equally apply to the taxation of VDA? Answer is yes. If on the occasion of marriage, your friend gives you a virtual digital asset as a token of gift, then yes, you can definitely say that it was acquired as a gift, so it is not taxable. So now we'll just touch upon some of the questions, and then I'll have some questions for you. IFO's head we have already addressed. As per recent ITET ruling, crypto sales profits prior to year 2022 to be treated as capital gain. Okay. Should we quote ITET decisions required for exam? So I think, to my knowledge, the ITAT decisions usually are not a part of the curriculum. The High Court and Supreme Court decisions is what would be expected. Unless the judgment is so significant that for your knowledge purpose, it has been explicitly kept. And yes, because those who are curious to practice the profession of tax, there is no limit to knowledge. You can definitely, for your knowledge purpose, follow the ITAT ruling. There have been a couple of rulings in the past where the tribunals have said that the profit from crypto transaction is not taxable, or if at all it is taxable, all expenses are to be allowed. Classification as capital gain versus business. So there would definitely be decisions, but those all would be prior to 22. Post 2022, the situation has been largely resolved. Of course, there are ambiguities which we'll see as we progress on the discussion. Now the third important. So largely our discussion would be around three parts. One, as I mentioned, the definition of VDA, which we just concluded. The taxation of VDA under section 115 BBH, we'll see the ambiguity, and the last part is the section 194S, which is TDS on transfer of VDA. Now, before we discuss the TDS on transfer of VDA, let us discuss some of the interesting questions, which are having a lot of ambiguity. One of the question is like, if an assessee is carrying on two businesses, one is a normal business, the another is he deals as a trader in the VDA. Now, this is very clear that the inter-head loss is not permissible. If I have incurred a loss in one head, that is not allowed to be set off against the income from other head or vice versa. Can an assessee who is doing who is incurring a common expense, like for example, I have an office, I do two businesses from office. One, I practice the profession of chartered accountancy. And second, I am also a dealer in the VDA. I incur a common office. I have a common office, so there will be a common depreciation, common premises, common admin expenses. Can I allocate the expenses between VDA as well as my normal business? The answer to that would be no. I cannot allocate the expenses, at least in relation to the activities which are relating to VDA. But yes, in some of the judgments, the courts have held that in case there are two businesses being carried out, assessee can allocate all the expenses in relation to the businesses which sort of are taxable. Like earlier, the controversy was in relation to the activities, like two set of activities I'm carrying out. One is generating exempt income and another is generating taxable. How do I allocate the expenses between exempt and taxable? Courts have said, okay, you have to adopt some rational means and allocate. In some situation, there are formulas like Rule 8DD. But then largely courts have upheld the stand of the SEC that yes, the expenses can also be allocated to one of the activities in some of the judgment. But yes, here there is no clarity about on that issue. Then often the question comes, if I purchase the virtual digital asset, let's say in year one, X quantity, I bought 100 quantity, the rate is $1,000 per coin. In the next year, I bought another 1,000 quantity, 100 quantity. Now I have 200 quantity. And again, the rate is, let's say, 2,000. In the third year, again, I bought. Fourth year, I bought. And finally, let's say after 10 years, I'm selling the cryptocurrency, which I have accumulated or acquired at different point of time at different valuation. While computing the capital gain, which cost should I take? Anybody would want to try? Or how is the situation if it is a normal sale of equity shares or a normal sale of any kind of capital asset? Which cost do we take? Anybody would like to give it a try? Should I repeat the questions? Okay, so someone has said we can use FIFO method, first in, first out. Okay. Any other? So those who have actually, anybody has actually or really carried out the transaction in relation to crypto VDA? Anybody has ever bought the crypto or sold the crypto? All right. So one of the answer which we got is FIFO method, first in, first out. So the ones which you bought first, you take them, take those costs and then consider it when you sell it, like first in, first out. Why not LIFO? Why not average method? I'll need answer from you guys. Anybody has bought, or within the family, anyone knows who has bought or has interacted with them or tried to inquire what it is, how it works? Anybody has seen taxation in your internship, taxation of VDA? They must be knowing. No practical knowledge. Very good answer. Okay, so how it works is, when you buy the Bitcoin or any other virtual digital currency, each such VDA will have a unique number. So although it was a Bitcoin yesterday, it is a Bitcoin today. But then whenever you buy the Bitcoin, each unit will have its unique identification number. So the concept of FIFO, LIFO or average method doesn't apply here. You have to take the respective or corresponding cost at which that unit was bought. So if it is A, B, C, D unit, you have sold A unit, then take the cost of A unit. If you have sold B unit, take the cost of B unit. One more question. We have already discussed that if you incur a loss on sale of crypto, you cannot set it off. And likewise, if you have earned a gain on sale of crypto or VDA, and at the same time you have any other business loss or capital gain loss under the head capital gains, you cannot set it off. That we have clear. We have 100% clarity. Take an example. I have got 2 Bitcoins. I am a trader, or even I'm an investor, doesn't matter for this question. I'm selling the virtual digital asset, VDA, Bitcoin, A, in which I'm incurring a loss. I'm selling unit B, in which I'm incurring a profit. So overall, my business activity is only one, doing the VDA transaction. Whether the loss from sale of unit A can be set off against the profit on sale of unit B. Anybody would want to try this? Can set off, okay. One answer is positive, yes, you can set off. Okay, second answer is also yes, positive, it can be set off. So see, there is no express, yes, VDA is based on blockchain concept, that is true. So there is no express prohibition as such. So far as this particular illustration is concerned, there is no express prohibition. At the same time, there is no express permission also. So in practice, a lot of taxpayers who are dealing in cryptos day in, day out, they have been taking a stand that yes, you can set it off because largely I'm dealing into one category, which is VDA, virtual digital asset. But then looking at the scheme of taxation and considering the provisions which does not allow you any deduction except the cost of acquisition, not even the expenditure, no set off of any kind of loss. One of the conservative approach which one school of thought has been taking is you cannot. So today both the views are permissible depending upon the sort of choice of the taxpayer. He may go and litigate, but yes, there is an ambiguity on this and only the time will tell when it is going to be clarified. One more question. Can I claim a deduction under Chapter 6A like ATC, ATD? I've earned a profit of 10 lakhs. At the same time, I made an investment in insurance product, 1,50,000 deductible under ATC. Can I take it? Okay, the answer is no. Okay, one of the answer is no. Any other answer? No. Okay. Can one of you would speak up why no, or you can put it on the chat also? Where is it mentioned that no deduction will be allowed in relation to deduction under Chapter 6A, which is ATC or ATD? See, if you carefully read para 2, it says in computing the income from transfer of virtual digital asset, no deduction would be allowed under any provision of the Act in respect of expenditure or allowance. So what needs to be noted here is it has to be an allowance, it has to be an expenditure under any provision of the Act. It does not stop you from claiming a deduction under Chapter 6A. Now, please note, when I'm making an investment or if I'm incurring an expense which is prescribed under Chapter 6A, ATC, ATD, ATE, and various other sections, those are deductions. They can be claimed. So ATC, yes, it is available to you. ATD available. So all kinds of deduction prescribed under Chapter 6A or any other section, they are available to you. Only expenditure other than cost of acquisition is not allowable or any other kind of allowance. Next question, whether rebate under 87A is allowable? The answer to that, again, for rebate, there is an ambiguity because rebate is neither a deduction nor an expenditure. So if you treat it as an expenditure or allowance, it is not allowable. If you treat it as a deduction, it is allowable. But then only the time will tell whether it is allowable or not. So now we will touch upon some of, because we have only now 10-15 minutes left, we'll deduct TDS provision and the circular governing the TDS provision. The rate of TDS, so under 194S, the obligation has been cast upon the buyer or purchaser, the one who is making the payment. Now, please note, the payer is required to deduct the TDS. It is not specified that payer has to be resident. What is important is any person, even if the payer is a non-resident or even if he is a resident, doesn't matter. He must be payment to a resident. The recipient must be the resident. In that case, the seller must be the resident. The sum by way of consideration for transfer of a VDA shall be subject to TDS at the rate of 1%. So TDS is 1% of the consideration, gross consideration. The person who is responsible for paying is responsible to deduct and deposit the TDS. The payee has to be the resident. Time of deduction, at the time of credit or at the time of payment, whichever is earlier. Whether consideration is recorded in the books of accounts, suspense account, whatever matter, doesn't matter. In whatever account it is, it doesn't matter. Cases where consideration, status of payer is not relevant, status of payee is relevant. Because as you can see, any person, the usage of the word is any person who is responsible. So even if a non-resident is making payment to a resident, he has to comply with the TDS provision. Cases where the consideration for transfer of VDA is wholly in kind or partly in kind or partly in cash. So this provision works largely on the lines of taxation or TDS on lotteries, where the similar thing is there. Like in lottery, if you win something in kind, then TDS has to be discharged come what may. So in this also, where the consideration is wholly in kind or exchange of another VDA. Like for example, you have got Ethereum, I have got Bitcoin. I can give Bitcoin to you, you give me Ethereum of equivalent value to me. So it's an exchange of crypto to crypto, VDA to VDA. There is no money involved. So entire transaction has been carried out in kind. Or alternatively, I pay part in cash or part in kind. So in both the situations, you have to see that the person responsible, this is important to note, the person responsible for paying consideration has, before releasing the consideration, he has to ensure that tax required to be deducted has been paid in such consideration for the transfer of VDA. So he has to ensure that the challan for amount equal to TDS has been deposited. Whether he deposits or the recipient deposit doesn't matter. Government is concerned only with the money. Then there is some relaxation. No TDS applicable in specified situation. No tax is required to be deducted under 194S, where the consideration is payable by person and the aggregate value of consideration during the financial year does not exceed the threshold prescribed. So if you are a specified person, being an individual or HUF, and the transaction value is less than 50,000, you are not supposed to comply with the provision of TDS. However, who is specified person? Specified person is someone whose sales is less than 1 crore, or if he is a professional, his receipts are less than 50 lakhs during the financial year, immediately preceding the financial year in which the VDA is transferred, or alternatively, you are not having any income under the head profit or gains of business or profession. So if either of these two conditions are satisfied, then you are a specified person. Oh, I'm sorry. Just give me a moment. Yes. Or in case I'm not a specified person, I'm any other person, then the threshold is 10,000. Like for example, in case of a company, AOP, BOI form, it is 10,000. What are the due dates of remittance? So quickly, in any other case, it is 30 days from the end of the month of deduction. For March, the due date is 30th April on the lines of TDS. In case of any other month, it is 7 days. Now, again, the due dates are dependent upon the type of person. If you are a specified person, then you are given 30 days. If you are an exchange, if the payer is an exchange or through circular, the liability is cast upon the exchange, then these are the dates. Or if you are any other person, then these are the dates. 30th of April for the month of March, 7th of the subsequent month in case of any other month. So I repeat, the liability is on the payer, that is the buyer of the crypto. If you are a specified person, that the one whose sales doesn't exceed 1 crore or 50 lakh as the case may be, and you are an individual or HUF, in that case, the due date is 30 days. In other case, it is, if you are an exchange or any other person, then it is 30th of April or 7th of the subsequent month. The forms prescribed are again different for different class of payers. The timelines are also prescribed, which is different. The return filing timelines within 30 days from the end of the month of deduction, or in case of any other person, there is a quarterly due date as we usually have for other kinds of TDS return. The certificate of TDS needs to be issued after return is filed in Form 16A in case of any other person, or in case the return filer is an exchange, or in a specified person, it is Form 16E. Now, one important point, we'll come to the illustration later. One important point to note here is that there is no applicability of 203A or 206AB on the specified person. Now, what does this signify? Specified person are typically those small taxpayers who may not be subjected to audit. So they have been relaxed from taking the TAN number under 203A for filing the TDS return. And they've also been relaxed from the requirement of 206AB, that is applicability of TDS at a higher rate in case the recipient is the non-filer of income tax return. In case of overlapping, like for example 194O or 194S, because 194S is a specific section, the TDS under 194S will prevail over TDS under 194O in case there is any conflict. The Central Board of Direct Taxes has been authorized to issue the guidelines. Now, to remove the ambiguities and difficulties with respect to TDS provisions. Now, these guidelines we'll just briefly touch upon due to the sort of shortage of time. The question 1, which has been part of the CBDT circular, that is, who is required to deduct tax when the transfer of VDA is taking place through exchange and payment is made by the purchaser to the exchange? So if I am a VDA buyer, under 194S, the obligation is on a VDA buyer to deduct TDS at the rate of 1%. But if I'm buying it through an exchange, in that case, from an administrative convenience point of view, the liability has been shifted on the exchange. So if you see, in case where the transfer of VDA takes place through or from exchange and the VDA is being transferred is owned by a person other than exchange, in that case, buyer would be crediting or making payment to exchange. The exchange then would be required to credit the payment to the real owner of the VDA, either directly or through a broker. Since there are multiple players, to remove difficulty, tax may be deducted only by the exchange. So this is very clear. If the buyer of crypto and seller of crypto are entering transaction directly without any exchange, then TDS liability is on the buyer. If there is an intermediary exchange, then what happens? The exchange will first buy the crypto from you and then it will transfer it to someone else. In that case, it is the exchange who is obligated to deduct the TDS because there are multiple stages involved for transfer of VDA. In case where the transfer of VDA takes place through an exchange and the VDA is being transferred is owned by VDA exchange. Now, say for example, an exchange itself is the owner and they are making transfer of VDA. In that case, what would be the situation? Now, in this situation, there are no multiple players. There is one exchange and then there are sellers. The buyer is required to deduct tax under 194S. However, there may be a practical issue. Buyer may not know whether the VDA being transferred is owned by exchange or not. I am just selling on exchange. Today, if you are possessing a VDA and you want to sell it, how will you do? Either identify someone who can purchase it. If there is nobody to purchase it, you will go to exchange and you will sell it. How would I know whether the buyer is exchange itself or the buyer on the exchange is someone else? So in that case, there may be a genuine doubt in the mind of the buyer with regard to responsibility to deduct TDS. This would be difficult if there's a buyer is buying a VDA from exchange through a broker. So then what the CBDT says, to remove this difficulty, it is clarified that the primary responsibility to deduct TDS remains with the buyer, or if you are selling through a broker, then through the broker. But from an administrative convenience point of view, the exchange would be required to furnish a quarterly statement for all such transactions of the quarter on or before the due date prescribed under the rules. The exchange would also be required to furnish the income tax return, and all these transactions must be included in such return. If these conditions are complied with, the buyer will not be held as assessee in default under these sections. So then what do you mean by exchange or broker? That is also defined and self-explanatory. Now in question 1, it was with respect to transaction where the consideration for VDA is not in kind. How will this operate in situation where it is in kind or in exchange of VDA? So this we have already discussed. It is clarified that in such a situation, as an alternative, tax may be deducted by the exchange. So this is from an administrative convenience point of view, the liability has been shifted on the exchange. Whether 194Q is applicable on transfer of VDA. Now 194O, there is an explicit clarification in the provision itself. In case of conflict between O and S will prevail. In case of Q also, if someone says that crypto is a goods and on purchase of goods, the TDS is applicable under 194Q, not under 194S. That can be the contention. So the CBDT clarifies that without going into the merit, whether it is goods or not, we hereby clarify that TDS has to be made under 194S. Whether consideration for transfer of VDA will be on gross basis after including GST or it will be on net basis after exclusion of this item. It is on the net. You have to exclude the GST. It is same, like in case of professional fee, in case of works contract, we have to exclude all kinds of GST and other payment. And likewise, in case of VDA, we have to exclude. If the transaction where payment is being carried out through payment gateway, there may be a tax deduction twice. Now, please note the obligation is on the payer. If the payment is being made through an exchange, the obligation is cast on exchange. If I'm using Google Pay, Phone Pay, or any other kind of these payment gateways, now these apps might have the facility to make payment for purchase or sale of crypto asset or the VDA. Then what is the TDS implication? Whether they will be technically called as exchange or brokers. Are they brokers? Answer is no. There is no agreement of agency or any kind of brokerage payment. Are they exchange? Whether one can frequently exchange the crypto asset on the payment gateway? Answer is no. It is just like a bank, a payment facilitation channel. So the obligation is not there on the payment gateway. Proper implementation, ABC may make an undertaking from XYZ regarding deduction of tax. ABC will not be required to deduct TDS on the same transaction. So I'm not getting into facts in great detail due to paucity of time. So you can read it because the illustration has been given in a very user-friendly manner. So then we have now some of the questions and the answers are also provided at the end of the study material. You can easily go through them. There is no ambiguity. We have some way or other, we have already addressed these questions during our discussion. Take, for example, what are the reasons for difference between e-commerce and traditional business transaction? How they cause difficulty to the taxation. So we have already discussed the issue of nexus, issue of characterization, issue of tracing and locating the transaction. E-commerce transactions have been replaced e-commerce transaction have replaced the concepts which are generally associated with the international transactions traditionally. Discuss briefly the taxation issues. So we have already discussed this, and then there are some equalization levy related provision. So I won't take much of your time because I'm waiting for the questions. If there are any questions, please feel free to raise the question now so that we can answer it for the benefit of all. Are there any questions? Okay. So was the session fruitful? Did you all understood everything? Let us try to solve one illustration till the time you think of questions. Let me take the benefit of this time. Yeah. So Mr. Abhinav, aged 32 years, he has following income. Interest on FD, interest on savings bank account, consideration on transfer of VDA, cost of acquisition of VDA is 21,000, and then expense on transfer of VDA are 1,000. So very simple. FD interest and saving bank interest, that comes to 1,25,000, which is less than the basic exemption limit of 2,50,000. Transfer of VDA is for 62,000 and cost of acquisition is 21,000. So the profit on transfer of VDA is 41,000. So if you see 1,10,000 plus 15.15 plus 0.41. So the total of everything comes to how much? Less than basic exemption limit in any case. 2.5 lakh se to kam ho gaya. Now the question arises whether the benefit of basic exemption limit is available to us. The answer to that is no. The rate of tax prescribed under 115 BBH is flat. That is irrespective of the basic exemption limit. You will have to pay tax on transfer of VDA at 30%. Additionally, the expense incurred on transfer of VDA will not be allowed to us, as we have discussed. Illustration 2. Mr. Siddharth, aged 24 years, he has earned income from salary 8.4 lakhs. Now, another example where income is more than the basic exemption limit. SB interest 12,000, consideration on transfer of VDA 50,000, cost of acquisition of VDA transferred 5,000. Mr. Harsh is employed with ABC Limited on a monthly salary of 50. In addition, he has an interest on SB account with Bank of India. Mr. Siddharth has not exercised option to shift out of BAC. That means he is within the new regime. Ignore TDS on computation of income of other than VDA. Now let us compute the total income. Salary income and savings bank interest income, 8,52,000. Income from transfer of VDA, 50,000 is sales consideration, 5,000 is my cost of acquisition. So 50 minus 5, net income taxable would be 45. 8,97,000 is my gross income. I'll first apply the tax on income other than VDA up to 3 lakh nil, 3 lakh, then slab wise 35,200. The normal slab regime would apply to the normal income. For tax on VDA, flat rate of 30%. My total tax liability 87,700, 50,648 after adding the education cess. Now the question comes, what would be the TDS liability? Now Mr. Harsh is a specified person since he does not have income under the head PGBP and the consideration payable doesn't exceed 50,000. As we saw the exemption, if you are a specified person, that is your income or turnover is less than 50 crore, less than 1 crore in case of profession, less than 50 lakhs. In this case, there is no business income at all. And the consideration amount is also less than 50. So there is no TDS liability or obligation on the part of buyer. So my net tax liability would be 50,650. Let us now deal with the loss situation. I have a business, Mr. Raj, 32 years age, assessment year 25-26. I have a normal business of 3,18,000. I've earned an interest income of 18,000. These both can be set off. So my net income would be 3 lakh. Consideration on transfer of VDA 420, cost of acquisition 20. Now, under section 71, as you all know, business loss can be set off against income from other sources. So my business loss of 318 can be set off to the extent of other income, which is fixed deposit. 115 BBH, business loss cannot be set off against other income. Therefore, the business loss of 3 lakh cannot be set off against VDA income. On the entire VDA income, my tax liability would be 124,800 by applying 30% plus education cess. And then the TDS would be undertaken on the gross value of transaction, that is 4,20,000 was a sales consideration on which this buyer would have done the TDS of 4,200. So my net tax liability would be 120 and 600. So I hope we are done with the concept of equalization levy and the taxation of virtual digital asset. In case any query remains, please feel free to ask me now, or maybe in the next session if we have in the next month. Ashokji, are there any questions? I think there are no questions, so we can sort of. All right, thank you. Thank you so much. So we are wrapping up with the session.